Might as well begin. All right, so today's topic, as I said, we have a full plate of analysis. We are going to discuss the Supreme Court decision on tariffs. Then we'll move on and discuss a little bit the economic data that we've had today. And as I said, it's in the title, it's not quite as bad as it looks. And then we'll move on to the coming war with Iran. At least I think there's a coming war. And then I want to just share a few thoughts on Tucker Carlson's latest antics. So let's begin with the Supreme Court. And as you all know, the Supreme Court took a long time, but they finally rendered their decision and they struck down Trump's tariffs. Now, interestingly, and I say interestingly, the timing of this decision was a surprise. But the fact that the Supreme Court would strike down this decision and rule that the executive branch does not have taxing authority is not really a surprise. People have asked me in recent months, might the Supreme Court support the president's tariffs? And my response was always, there's a 0% chance that the Supreme Court is going to support Trump's tariffs. Now, 0% was probably overstating the case, but I would say zero just to make clear that it's highly, highly unlikely that these tariffs are going to stand because, very simply speaking, tariffs are a tax, and the executive branch cannot unilaterally impose taxes on the American public. And nevertheless, we did see a market response, and we'll see if the market response lasts. But so far, the equity market is cheering. And you never know, right? We're living in volatile times. So it wouldn't surprise me if by the end of this call, the gains are, who knows? But at least the knee-jerk reaction by the market is favorable. Now, why is that? And anyone who's been listening to in this program and attending these calls ever since these tariffs were imposed should know the answer why the market is happy, because tariffs are a negative for the economy. They exact a pretty high cost. The cost is in terms of lower GDP growth than we would have had otherwise, higher unemployment than we would have had otherwise, and at least for a brief period of time, and we'll discuss a little bit later how brief that might be, higher prices, higher inflation. Okay, so not a surprise that the market likes the rejection of these tariffs. Again, what might be a surprise is this outcome should have been expected. Again, the timing not so expected necessarily because it could have come 2 months ago. It finally came today. But the result that the Supreme Court would overturn the tariffs should really not be a surprise. Now, the decision raises some important questions now going forward. Top of mind is, will the government return the tax revenues that they collected from tariffs? And the Supreme Court really didn't give a lot of guidance here. The implication is that these revenues should be returned, but the way they're returned, to who they're returned, how much is returned, the timing of returning those tax revenues to the companies that were charged, all of this is left in the air, and we really don't know. And the question is, how much flexibility will the government have? Might it just hang on to these tax revenues indefinitely? That is not entirely impossible. And we might need to see companies bring another lawsuit in order to define, to give more definition of how to treat these tax revenues that the government raised from these tariffs. So that's one issue. Another big question is how it relates to trade deals that have not been signed and sealed and delivered. The Trump administration has is in the process of still negotiating some deals out there. In other cases, the deals have been agreed to at the executive level, but in some cases, the parliaments and congresses in other countries haven't approved those trade deals. So what's going to happen with those deals? That's another question mark, which we just don't know the answer to. But you could expect to see some slippage on these trade deals, and some of these trade deals that Trump thought that he had in his pocket may slip away from him. And then the final big question is, we know now that these sweeping tariffs are over. Trump cannot, with a stroke of a pen, just reimpose tariffs. He will reimpose tariffs to some extent, but they're likely to be more limited. His team is going to have to get into the nitty-gritty details of which sectors to impose tariffs on, the levels which they'll impose those tariffs. They're going to have to read, and I'm sure a lot of this stuff has been worked on. Maybe they're ready to roll it out immediately, but the tariffs will not be as sweeping. And it even gives the opportunity of the Trump administration to roll back some of these tariffs. If they believe that they could create an acceleration in the economy and have some lower inflation by rolling back some of the tariffs and not being quite as aggressive, they might very subtly take advantage of this moment. I'd say the net of all this is probably an economic positive, right? Fewer tariffs are better. But we do have these uncertainties, which I just discussed. So that's really it with the Supreme Court. I think the market will now look forward, and I think the whole tariff saga is mostly behind us. Some of these concerns that I mentioned are not going to be top of mind for investors. I don't think they're going to have such a dramatic impact on markets going forward. It will be very interesting to see as the months go by if the new round of tariffs, which Trump will implement on a more piecemeal basis, if they are more modest, will we see better inflation numbers later in the year as a consequence of a diminished approach to tariffs? So that to me will be very interesting. And better inflation numbers, and could we see an additional reacceleration of the economy? I think we would already we'll already get an acceleration in the economy, but will we get an additional boost because tariffs will not be as sweeping going forward? So all in all, the market is viewing this as a positive, at least for today. I view it as a positive as well, but like I said, this is not a surprise. Okay. Now let's move to the economic data. So over the last few days, yesterday we had important data on the jobs market. As you know, every single Thursday morning at 8:30 a.m., we get the initial jobless claims numbers. The sweet spot for those numbers is somewhere between 215,000 people filing for jobless claims and 240,000 people filing for jobless claims. So these are people every single week who have lost their jobs and they're filing for unemployment insurance. So 206,000, the number that we got yesterday, is below that sweet spot. That means it's an exceptionally low number of people that are losing their jobs. We had seen the prior 2 weeks a bit of a blip upwards to around 225, 227,000 people losing jobs, but that was very much weather related. Remember, we had big snowstorms. Well, now that those snowstorms have cleared and the data is sort of normalizing, we see that, and 227,000 people losing their jobs is also not very high, but we're comfortably below that. And that is pretty good news for the labor market. Now, we know that there's not a lot of hiring going on. We're going to talk about that again further in a little while. But people are not getting fired from their jobs, and that's very good, and that's a key reason why the unemployment rate is at a low 4.3%. So that was yesterday, and that was good news. Today we got at least the headlines looked kind of nasty. We had fourth quarter GDP released, fourth quarter GDP from 2025, and that number came in at 1.4%. So that was a very low reading. The Atlanta Fed's real-time GDP tracker was showing that the economy expanded by 3% in the fourth quarter of last year. So we're well below that. Now, Wall Street economists actually were more right than the Atlanta Fed's GDP tracker. Wall Street economists were looking for, this is the consensus survey, we're looking for 2.5%. But that is still significantly higher than the 1.4% that we got. Now, after yesterday we also got trade numbers. We got the trade balance for December, and that those trade numbers showed a much larger than expected deficit. So imports were stronger than expected and exports were weaker than expected. That subtracts from GDP growth. So as a consequence of that those trade numbers, the whisper number for today had been revised down to 2%. So remember I said the consensus among Wall Street economists was 2%, but given the trade numbers we got yesterday, that number was quietly revised down to 2%. But again, 1.4% is even lower than that. So why is that? And it seems that the forecasters, and certainly the Atlanta Fed's GDP tracker, wasn't taking into account sufficiently the effects of the government shutdown, which, if you recall, that was a very long-lasting government shutdown. It was the longest government shutdown we've had in history. And estimates are that the government shutdown subtracted 1.15 percentage points from GDP growth in the fourth quarter of last year. So if you were to add that 1.15% back to the official number of 1.4%, that would have given us GDP growth of 2.5%. So actually 2.55%. So that Wall Street number was actually spot on, and the Atlanta Fed's GDP tracker, wasn't so bad. They were looking for 3. This would have come in without the government shutdown of 2.55. So the bottom line here is if it weren't for the government shutdown, the economy would have expanded by 2.6%, which is pretty solid growth. It's not spectacular, but it is absolutely solid and nothing to worry about, right? This is not smelling like a recession. It's not smelling like a dramatic slowdown. And in fact, we're going to get that 1.15% back, right? This is not growth that's lost forever. All these incomes get paid back with a delay, and we get most of that GDP growth back in 2026, sometime in the first half. So we're going to come into this year, into 2026, with some pretty good momentum. Okay, so all in all, the growth number wasn't so bad. Now let's move on to the inflation data. We got the PCE inflation data. Remember, the PCE inflation numbers is the inflation indicator that the Fed uses for its 2% inflation target. Okay. We also get earlier in the month CPI data. That's a different inflation indicator. But the Fed focuses on this one in terms of its inflation target. So if you were listening to the financial press, I had the CNBC on as I was waiting for the data, and I just immediately heard them say the numbers come in much worse than expected. The inflation numbers come in significantly higher than expected. And I just sort of said, okay, wow, it came in, and I hadn't really looked at the data yet. I have a spreadsheet with all the forecasts down. I have every Wall Street firm's forecast, and then I have the average, which gives me the consensus forecast. And but I just said, okay, inflation came in terrible. And boy, is that strange, by the way. Boy, is that strange that Wall Street missed this by such a large margin. Why is that so strange? Because by the time we get the PCE numbers, we have already had earlier in the month CPI inflation and PPI inflation. PPI inflation is producer inflation. And all you have to do is take the key numbers from those inflation reports and plug it into PCE, and you pretty much know what the number is going to be. So it's very, very rare that forecasters will miss in a bad way the PCE number. They may miss by a touch, but to have a big miss, highly unusual. But look, CNBC, I figured they got it right. So afterwards, I look at the numbers myself, I looked at my spreadsheet, and CNBC was completely wrong. The forecasters got this number perfectly. Perfectly. The expectation was that core inflation, which strips out food and energy, would be 3% inflation over the last year. That was the expectation, and that's where it came, 3%. And the expectation for headline was 2.9%. And that's what it came in, exactly. And if you look at every single major Wall Street bank, Goldman Sachs, JP Morgan, Citibank, Bank of America, you name it, they all got it right. No one missed this. So I don't know what CNBC was talking about, but that was wrong. So even though the news stories were that this was ugly data, when you get right down to it, the GDP number was really not that far off expectations, and most of it was attributable to the government shutdown, and the inflation numbers were spot on. So all in all, from the data releases that we got today, the picture of the economy remains unchanged from where it was yesterday or the day before or a month ago. Okay. The data that we got only confirms what we already know, despite the bad analysis we got from the financial press. Okay. That is a good segue to the Fed. So we also got this week the minutes from the last Fed meeting. And the minutes were very interesting. Now, we know that the Fed has been divided between those who want to keep interest rates where they are and those who want to cut interest rates. But these minutes provided more nuance than we're accustomed to seeing. And I want to go through those nuances because it'll better help us understand exactly where the disagreements are among Fed members. So there's really four different groups, four different camps within the Fed and how they're thinking about inflation and how they're thinking about the economy. The largest group, and this is, I'm pulling all this information from going through the Fed minutes. The largest group are those who want to patiently wait until inflation is convincingly lower and inflation converges to their expectations before cutting interest rates again. So this group, again, it's the largest number of voters at the Fed. They're really in no rush to make any interest rate reductions. They're waiting on the data. They're open to cutting interest rates. They're not concerned that the economy might be too strong. They're not concerned that the unemployment rate might be too low to cut interest rates. So they're not fearful that if they cut interest rates, you'll get an acceleration in inflation. That's not their concern. Their concern is simply that inflation is sticky and it's not coming down. It's been stuck above the Fed's 2% inflation target since the last quarter of 2021. And therefore, their concern is if they cut too early, they'll lose their opportunity to bring inflation down to the 2% target. Okay? That's the largest number of voters at the Fed. Now, there's also a second group. The second group also is in no rush to cut, but they want to wait even longer. They not only want to see inflation converge to the inflation target, they want it to stay there for some time. They want to make sure that inflation is really convincingly anchored at 2%, or maybe even lower, but 2% before they cut interest rates. Their concern would be that it could hit 2% for a month or two and then bump back up. Again, they're open to cutting interest rates, but they want to wait even longer than the first group before cutting interest rates. Because their worry is, right, inflation hits 2%, great, they feel relieved, they go ahead and cut interest rates, and then inflation bumps up again and goes back above 2%, and then they're stuck, right? They're stuck with this higher inflation rate, and they've already cut interest rates a little too soon. So that's the second camp. Then we have a third camp. This is probably, based on the language of the minutes, the same number of people that are in the second group. So the first group I mentioned is the largest. Then we have two groups which are significant, but they're a bit smaller, right? The second group I just discussed. Here's the third group. They believe that the current interest rate that the Fed has is the neutral rate. What's the neutral rate? The neutral rate means that it's basically perfect. It's exactly where you want to end up. As long as the economy isn't going into a recession, you shouldn't cut interest rates. And as long as inflation isn't accelerating, you shouldn't raise interest rates. So they believe just keep interest rates exactly where they are, and we're good. We're in good shape. So they believe that the Fed should say, we're where we need to be for the long run. And going forward, only a material change in the state of the economy should bring us to make a change in interest rates. And the likelihood of an interest rate cut going forward is just as likely as the likelihood of an interest rate increase, because where we need to be. Then we have a fourth camp, right? And the fourth camp are those, and this is probably the smallest group at the Fed. They believe that the Fed should have cut interest rates at the last meeting. And they should cut interest rates. Since they didn't cut interest rates at the last meeting, they should cut interest rates at the next meeting. We know who these people are. One is Christopher Waller, who very much wanted to get appointed to be the next chairman of the Fed. He didn't get the position, but he's still voting for interest rate cuts. The other one is Stephen Myron, who Trump recently appointed to the Fed. And it's probably just those two. There might be one other person in this group. Her name is Michelle Bowman. But she did not dissent and vote for an interest rate cut at the last meeting. She may be sympathetic to this view that we should be cutting interest rates, because if you listen to her when she speaks, she's more open to interest rate cuts, but it's not clear that she's in this camp, but she may or may not be. So, but we know for sure two people are in this camp, and there might be this third. So you can see the Fed is very split and probably more divided than it was even a few months ago. And it's certainly more divided than it's ever been in my 33, 34 years of being an investor. And it's probably the most divided it's been, maybe even, back to, let's say, the 1920s when we were in the Great Depression. So I can't recall a time where the Fed has been so divided. So why does this matter? Why does this matter? Well, it matters especially because soon enough, we're going to have a new chairman of the Fed, Kevin Warsh, and he is really going to have his hands full if he actually wants to cut interest rates. Trump thinks he brought in Kevin Warsh to cut interest rates. He thinks that's Kevin Warsh's job. And for sure, Kevin Warsh told the president in their private interviews that he would come in and cut interest rates. Kevin Warsh has said it publicly. He said he wants to shrink the balance sheet of the Fed, but he wants to cut interest rates. But there's almost no chance that he's going to be able to come in and do that immediately because he has a very divided Fed. Now, maybe he won't want to cut interest rates immediately, right? If he comes in and the inflation rate is running at about 3% where it is today, a full percentage point above the Fed's 2% inflation target, he may come in and say, I didn't really expect inflation to still be at 3%. So he may be with the majority of members who are of the view that, yes, we want to cut interest rates, but we need to see inflation begin to converge towards where we think it should go. Right? It should at least be moving in the right direction. But even if inflation is not at 3%, let's say it's at 2.5% or 2.4%, Warsh is going to have a very, very difficult time of convincing the Fed. And you can be sure if when Warsh comes in to that seat in June and he doesn't cut interest rates, Trump is not going to be happy. But the chairman of the Fed is not a dictator. He needs to get a consensus. He needs to get a majority of opinions in order to move interest rates. And at this stage, that looks like it is going to be very, very difficult. Now, he might be fortunate, and by the time June rolls along, the inflation picture may look much better. But right now, he does have his hands full. Now, I want to talk a little bit about why. Why is it that the Fed is so divided? Because I said that the Fed has never been so divided in my career, and maybe even the most divided it's been since the Great Depression. What is the cause of such divide? You can't just make a statement like that, like I just said, and not explain why that's the case. And by the way, nobody explains it. You'll read in the Wall Street Journal what I essentially just said, right? That the Fed is super divided. They might not have given you the detail and walked through the 4 different camps the way I did, but a divided Fed and Warsh maybe having his hands full, that you can get from any good financial newspaper or financial journal. But nobody explains why the Fed is so divided, and now we're going to get into that. Okay? So this is really inside baseball, PhD level, not undergraduate level, PhD level understanding of why the Fed and actually the economic community is so divided over what to do with interest rates. Okay. And there's 2 reasons. Reason number 1, not surprisingly, is tariffs. Economists have very different views on the impact of tariffs on inflation. Now, all economists believe that tariffs are damaging to the economy. They're damaging to GDP growth and employment, right? You really can't find an economist outside the Trump administration who doesn't understand that tariffs are very damaging to GDP growth and to employment. And this is borne out by lots of historical economic data, and many studies have shown this very clearly that, again, that tariffs hurt GDP growth and hurt employment. So where's the disagreement on tariffs? The disagreement comes as it regards to inflation. Some economists believe that the inflationary impact of tariffs is very short-lived, right? You get a little bump up in inflation, but it doesn't last very long. It's a one-time price increase that fades fairly quickly. And by the way, Jay Powell, the current chairman of the Fed, has that view. And every time he speaks, he expresses that view. That also happens to me, but my view, and some others at the Fed. And those who want to cut rates, but they just want to see a little bit more evidence that inflation is coming down, they hold that view. So the question is, why wouldn't the inflationary effects of tariffs fade quickly? Why would the inflationary effects of tariffs last longer? Well, here's the theory. Once people start paying higher prices for goods, these same people could begin to expect that the pace of price increases will continue into the future, right? So they just got a big jump up. Let's say that the cost of lumber just went up by 25% because of tariffs. Well, builders, homeowners, you name it, they could expect that the price of lumber could continue to increase pretty significantly into the future, that it won't be just a one-time thing. So even though the direct impact of tariffs won't last, these higher expectations that prices could continue to rise in the months and years to come, those expectations of higher prices can get embedded into the collective psychology of people. And these expectations themselves will fuel higher inflation well into the future, beyond the short-term impact of the tariffs themselves. Okay, this is called, in PhD language, embedded inflation expectations. Embedded inflation expectations. So some at the Fed have this concern and others don't. Those who have this concern are reluctant to cut interest rates anytime soon. They think we need to wait and wait and wait until it's absolutely crystal clear that we don't end up with these embedded inflation expectations that push inflation further and further and further away from the Fed's 2% inflation target. Okay, so that's one key source of disagreement at the Fed. Okay, let's move on to number two. Immigration is the second reason economists have different views on what the Fed should do with interest rates. Why is that? Since the crackdown on illegal immigrants, we've not only seen illegal immigration slow or come to actually a screeching halt, but we've even seen legal immigration slow down dramatically. And the result of all this is the US right now is having almost no immigration to this country. Now, there's a pretty important economic effect of no immigration. What's the economic effect? The available supply of workers in the United States has dropped significantly. Now, some economists believe that the lower number of jobs being created every month is due to fewer people looking for jobs. If you don't have all these immigrants coming into the country, that means fewer people want jobs. So there's fewer people available to hire. So if fewer people want jobs and there's nobody to hire, that means the unemployment rate should remain pretty much unchanged. And that's what's happening, right? Even though job growth has slowed down dramatically, the unemployment rate remains low at 4.3%. So that supports the view of those economists who think hiring has declined because supply of workers has declined. Fewer people are even looking for jobs. Again, if there were people looking for jobs that couldn't find jobs, you'd see a rise in the unemployment rate. And the unemployment rate would be a lot higher than the 4.3% that we see. So, again, just to emphasize, lower hiring or low hiring is a result of few people looking for jobs. And few people looking for jobs is the result of low immigration. So, these economists who buy into the argument that I just presented see no urgency to lower interest rates. They're not concerned about the low pace of hiring. But then there's another group of economists. And this other group of economists disagree with the view that we are seeing low hiring simply because of a low supply of workers, low immigration. And this second group of economists, they worry that it's just a matter of time before we see this low pace of hiring translate into a rising rate of unemployment. And these economists therefore believe that there is an urgency to cut interest rates, to stimulate demand in the economy, and that will generate, in turn, job growth. So that's where people like Chris Waller, who want to lower interest rates now, that's him. Stephen Myron, that's him. We need to lower rates urgently because hiring is slow. Now, these are honest disagreements among economists. These are honest disagreements that members of the Fed are having every single day. And they use data to support their cases. But you have an external complication that's entering into this debate and making the Fed's job harder than it should be. What is that external complication? Well, you have the President of the United States and his economic advisors muddying the waters constantly, complicating things. How are they muddying the waters? Well, let's give a recent example that just happened a couple of days ago. So earlier this week, a new research report out of the New York Fed was published. And this research report was really an in-depth look at the impact of tariffs on the economy. And this is a current study. They didn't go back and look at history. They looked at right now, what's going on right now. And the paper demonstrated, listen carefully, the paper demonstrated that 90% of the costs of the tariffs are paid by U.S. businesses and U.S. consumers. That is to say, this study showed that foreign businesses that export into the United States, they have not responded to tariffs by reducing their prices in response to those tariffs. If they had reduced their prices, they would have absorbed the costs of tariffs, right? They would have said, oh, the tariffs are higher. We still want to sell our products into the United States. We still want our products to be attractive. So we're going to cut the cost. The lower prices that we charge are going to bite into our earnings, but we want to protect our market share in the United States. So we are going to cut costs. So this paper said that's not what's going on. Instead, most of the costs of the tariffs are being passed on to U.S. importers, that is U.S. businesses, as opposed to being eaten by the foreign businesses. And then the U.S. businesses, they absorb the higher costs from the tariffs, and then they make a decision. Do they eat those higher costs and have it bite into their earnings, or do they pass on those higher costs to the U.S. consumers? And it's some combination. They do a little bit of both. They take a hit on earnings, and they also pass some of the tariff costs on to us, right, the consumer. Now, honestly, this is not really a surprising result, right? Previous studies that have done throughout history show similar results. And in fact, there have been other studies done by researchers very recently researchers at Harvard, researchers at University of Chicago. Actually, an institute in Germany known as the Kiel Institute. They also recently did a study. Even the Congressional Budget Office in the United States did their own study. And all these studies show the exact same result, that 90% of the costs of tariffs are paid by U.S. businesses and U.S. consumers. Okay? Controversial? It shouldn't be. But of course, the Trump administration doesn't want to hear this. So, again, a few days ago, Kevin Hassett, who is a key economic advisor to President Trump, he came out on the news and he called this study done by the researchers at the New York Fed an embarrassment and said the authors of the study should be disciplined. Now, Hassett's criticism focused on the following. He said that the study didn't look to see if new U.S. businesses were formed to replace the high cost of imports. That is to say, if the cost of imports became unaffordable for Americans, then it's logical to think that new U.S. companies would be formed and they would produce goods to replace those imports that became too expensive for us to buy, right? He basically argues that's probably what happened. There's all these new companies supplying goods to U.S. consumers, so there was no price to pay. America is better off. The American economy is better off. And it's true, the study did not look to see if new U.S. businesses were formed. It's true. That's not what the study was focused on. But we know that U.S. businesses were not formed. If U.S. businesses were formed to any significant degree, we would see important job growth, right? We would see very significant job growth. And the fact is, we've seen anemic job growth, incredibly disappointing job growth, right? Something we discussed earlier. So Kevin Hassett is just criticizing because he's very unhappy that the New York Fed published these results that make tariffs look bad. And that's not good for the Trump administration. That's the only reason he came with this criticism. For sure, he knows better. But let me ask you this question. I said the Trump administration has muddied the waters for the Fed and made their job more difficult. And that's really the key point. Why is that? Well, if you're at the Fed and you're hearing these kind of attacks against you constantly, and these attacks are pretty constant, and all of these attacks are pretty absurd, and if you're at the Fed, they're enraging, will this make you more or less likely to make the Trump administration happy by reducing interest rates? Okay, these people are at the Fed, they're human beings. And if they're getting attacked unfairly on a daily basis, they're going to be more likely to dig in their heels and hold rates where they are and not cave in to the constant criticism of the Trump administration. Now, immediately after Kevin Hassett made this criticism of the Fed study, one of the Fed members, his name is Neil Kashkari. He is the president of the Minneapolis Fed. He came out and he said, Hassett's comments about the Fed staff research were just another step to try to compromise the Fed's independence. Well, I'm quite sure that 95% or maybe 100% of the members of the Fed share this view. And it should be very clear that Trump and his team are not helping themselves in their objective of getting the Fed to lower interest rates, right? These constant attacks and totally unfair attacks really only get the Fed, I think, to be more reluctant to cut interest rates. So that's where we are in terms of the the Supreme Court and tariffs, the economic data, and the divisions at the Fed, and this extra complication which is being created by the Trump administration itself. This extra complication in helping the Fed or preventing the Fed from really thinking through these issues more clearly. Because they're difficult issues. There's real serious disagreements among economists among some of these issues, and they're not easy. And the Trump administration doesn't make it easier. Okay. Now I think it's important to move on to what had been the focus of the markets until the Supreme Court's decision, geopolitics and specifically Iran. This really is the big issue. First, let's discuss timing. So the latest comment from Trump himself has said that he is willing to give another 10 to 15 days to negotiation. Now, we've mapped out why Trump might be buying some time here. Number one, we talked about Ramadan, which is the Muslim holiday, which ends on March 19th. So I have suggested that the window for an attack probably really opens now after March 19th, but that's not set in stone, right? These are rules of thumb. They're not hard rules. Now, another important factor to consider is the USS Gerald Ford, which is this aircraft carrier strike group. It still has not arrived to the area. It's close. We thought, the reports were that it would arrive either today or tomorrow. Apparently, it's at least in the next few days. I've suggested that to get the strike group up to peak performance potential, that requires about 2 weeks. Okay, so the day it arrives, they're not really ready to go. They could really use a couple of weeks more. Now, that doesn't mean they'll take the 2 weeks, but we're just, again, in terms of most likely time for attack. Trump has told us 10 to 15 days. We talked about Ramadan ending March 19th. We've talked about the carrier strike group, the USS Ford, still not there yet, and they could use an additional 2 weeks from the day they arrive. Now, here's another factor. Marco Rubio has a scheduled trip to Israel next week. Now, of course, that trip could be canceled, but the United States, if he arrives, there's no way the United States is going to attack when Marco Rubio's in Israel. That's just not going to happen. So we'll wait to see if his trip is a go and he arrives in Israel. We know that there's no attack as long as he's in Israel. So my guess is still that we're not ready to go yet in terms of the U.S. Striking. But again, these are rules of thumb. They're not hard rules. So anything is possible. But another key point to make, Trump does not need to rush right now, right? There is nothing pressing. There are no protesters on the streets, right? It was pressing, right? If we were to go back a month ago, there were millions of Iranians on the streets trying to overthrow their government, and their lives were at risk. At least 40,000 of them were murdered by the regime. It was pressing. Lives might have been saved had we attacked at that time. But that window of saving lives has closed. So now Trump has time. He doesn't need to rush. He can afford to wait for the USS Gerald Ford to be, he can give them their 2 weeks time to get to peak performance. If Trump so chooses, he can wait till Ramadan being over because he could be afraid of offending the Qataris or the Saudis by striking during Ramadan, right? He does not have urgency. Now, timing is not really the issue, right? The real issue is, are we going to strike? And if we do strike, is it going to be a big strike Or is it going to be a modest strike? Those are really, are we going to do it? If so, how big? Those are really the big questions. Well, to help us answer those questions, it's really important to understand incentives, the Iranian regime's incentives and Trump's incentives. And we talked a bit about this last week, but I want to review it and maybe share some other nuances that maybe we hadn't considered. So let's look at it from the Iranian side first to help us get some clarity. Now, Trump seems to want a deal if he got absolutely everything he asked for, right? At least that's what he's saying. And you know what? If Trump actually got 100% of everything he asked for, which is an end to Iran's ballistic missile program and surrendering the ballistic missiles that they have, a commitment that they will not revive their nuclear program, and a really thorough inspections regime to ensure that they don't pursue nuclear, airtight inspections regime. And if Iran made a pledge that they would no longer harm protesters, Trump might just go for a negotiated deal. It's possible. I just want to hold that out as a possibility. What about Khamenei, the leader of Iran? What are his incentives? Does he actually want a negotiated agreement? Well, it's interesting that Khamenei continues to insult Trump. In fact, every day. He insults Trump, he insults the United States every single day, and he continues to threaten them. He tells them, we're going to sink your ships, we're going to shoot down your jets. You are going to feel pain like you've never felt before. Constantly, he prods, he insults, he tries to intimidate. It's important to know that Khamenei and the Iranian regime, they are not working, and they have never worked according to Western principles. Western principles of rationality, which are self-preservation, fear of destruction, fear of being wiped out. Khamenei does not act like what we would consider to be a rational actor. Trump keeps saying he learned his lesson during the 12-day war. He knows he wants to survive. Of course he's going to make a deal. Of course, Trump continues to say that. Now, is Trump just saying that, or does he actually kind of think that? Because it's pretty clear that's not the way Khamenei and the Iranian regime operate. They do not think they lost the 12-day war. If you just listen to them, and I don't know if Trump listens to them or if anyone on Trump's in the administration explains to Trump, they probably do. Trump probably knows. He's probably just talking, but I'm not 100% sure. But if you listen to the Iranian regime, any of them, the foreign minister, the leader, any of his advisors, they believe they won the 12-day war last summer. They truly believe it. And even though they were hit very, very hard, Hamas was nearly wiped out. Hezbollah is nearly wiped out. The Houthis were devastated. They think they won. And the reason why they think they won is because they survived. And to them, surviving is victory. Now, if the Iranian regime survives whatever comes next, if they survive an attack the way they survived the 12-day war, they win. In their minds, they win. On the other hand, if Khamenei and his regime surrender through negotiations, it would be a Muslim country bowing down to a Christian country. And that is out of the question. It's the ultimate humiliation. It's far better to die as a martyr than to bow down to a Christian country or a Jewish country, Israel. Nothing worse. Nothing worse. So he would prefer to go down in a blaze of glory, but more likely survive. Even if he doesn't survive, the regime will probably survive. If you, again, we have discussed this in the past, as long as the regime survives, they win. And the odds that Trump goes all the way and takes out this regime and goes for a regime change based on their view, based on what they've witnessed before in history, Trump is not going to go all the way. The United States does not have that moral character. It doesn't have that toughness. It doesn't have that at all costs burn the Iranian regime down. That's not what we've ever done before, right? And if you look at all recent wars since Vietnam, right, we've inflicted a lot of damage, but at the end of the day, we call it quits. That's what he sees. That's the track record. So in his mind, you go for survival, and that's victory. And of course, as we've mentioned, in their view, Allah has their back, and Allah has a plan. Allah meaning God. So with that in mind, if Iran, in their view, wins through survival, what does that mean for the Trump administration? And by the way, it could be a lie, right? Survival, if you're just completely beaten down, if all your nuclear facilities are even more destroyed and your ballistic missile capabilities are wiped out, and if the elite IRGC, the elite army is absolutely decimated, that's not a win. Maybe you survive, but to call that a win is absurd. But it will be sold as a win. And this is the important thing. It will be sold as a win. And anyone who wants to believe it can believe it. And something we should know even in our own country. Reality can be a lie. I mean, a lie can turn into, a lie can turn into reality. Because perception creates reality. Perception creates reality. It could be a fib, but if you tell a lie over and over and over again, people come to believe it. And if in the Middle East, the regime survives and they say they won, you'll have the Middle East believe that Iran won. And that's a problem. Getting to Trump's incentives now. Trump cannot have our enemies tell the story that the Iranian regime won. He can't be in a situation where a lie becomes the truth. That's point number one in terms of Trump's incentives. Point number two, Trump has made this enormous military buildup. And if he doesn't take this huge military buildup and transform it into real powerful action, Trump will look weak, right? This is the largest military buildup we've seen since the Iraq war in the early 2000s. And if it's just all a show, all a masquerade, all chest pounding, but it's not followed up with a devastating blow, a wounded Iranian regime is just not good enough. It's just not good enough. It will just look like Trump ego, right? Big chest pumping. Trump, for his own sake, for his reputation in the world, for the United States' reputation in the world, he needs to deliver a really decisive blow. So if we don't do regime change, I think it will be a bad outcome. Again, because perception becomes reality, at least for a very long time. So, what is regime change? At a minimum, it's the leader Khamenei being killed or at least ousted and sent into exile, probably killed. And many of the leaders surrounding him need to be wiped out. I think that's the minimum. Now, what that new regime looks like, it could take various different forms. But for victory and to prevent the regime from claiming victory, that's what you need. Now, I promised a little mention on Tucker Carlson, so I'm going to do that. I'm going to do that. You may or may not have heard that Tucker Carlson arrived in the Ben Gurion Airport, which is the airport in Tel Aviv in Israel, and he never made it out of the airport. And the reason he never made it out of the airport is because he claimed that he was detained by the security, by Israeli security at the airport. He was detained, and he almost made it sound like he was arrested. Now, what's the truth? What really happened? Well, anyone who's ever been to Israel knows that when you get into the Israeli airport, for security reasons, because for obvious reasons, they're surrounded by terrorists who want to blow up as many Israelis as possible, you go through a thorough line of questioning. Okay. Now, Tucker Carlson paid for special services. You can pay extra money and you can go into a VIP lounge. So rather than being in the main part of the airport where, regular people get questioned, he was in a VIP lounge where he was questioned. And that was it. It takes maybe 10 to 20 minutes and then you're free to go. And Tucker called this like being detained. Now, this is an absolute joke. And anyone who knows the truth, and it was, by the way, there are videos out now of what really happened, of Tucker being, hugging some of the people in the Israeli airport, the security, taking selfies with them. He's smiling, he's happy. That was the truth. But Tucker has a friend who works in the media, and this lie, this absolute lie, was leaked because Tucker has an agenda, and he despises Israel. And no matter what happens to him, he's going to spin it into really disgusting lies. So this has been Tucker's obsession for the last, I don't know, year and a half or so, trying to really tarnish Israel's reputation. It's his absolute obsession. 100% of what he says is a complete lie. Not 99%, 100%. And this is one of the most absurd lies that he's told, and so obviously refutable. But it's now beyond me how this guy has a following, and he's got a huge following. And it goes back to my earlier point on Iran. If you repeat a lie again and again and again, you can alter perception. And that perception becomes reality for many, many people. And this is Tucker's game. And why is Tucker doing this? He's doing this because he knows that Christians in the United States support Israel. And they've always supported Israel. And especially evangelical Christians, but Christians generally, their support for Israel is a big part of the incredible bond between the two countries. And Tucker is determined to break that bond between the Christians of the United States and the Israeli population. That's his angle. That's what he's hammering at. That's his obsession. Why he hates Israel so much, I couldn't tell you. Only he can tell you that. But it's obvious, and it's obvious what his game is. And hopefully, one of these days, people will begin to see through these distortions and these outright lies, because he really is causing a huge amount of damage. And he, no question, has fractured the Republican Party to some extent as a result of his efforts. So anyway, we went well over an hour. Let's take a break and see if anyone has any questions.